Hi, and welcome back to Your Future, Your Finances. We're continuing our conversation with Jon Giordani, CFA and Chief Investment Officer of Planning Solutions Group. We're talking about the investment markets. Thanks for coming on the show. So before the break, we were talking a little bit about the markets. There's a mood across the world that seems to be rather pessimistic at the moment. You mentioned the UK leaving the European Union, or what's called Brexit, and there's the election. What do you think is going on at the moment in the markets?
Yeah, I mean, I think all of this is interrelated, and what I mean, let's think about what happened 10 years ago. There was a global financial crisis back in 2008 and early 2009. Across the world, economic growth just came screeching to a halt. Unemployment spiked, and financial collapse seemed like it could happen. We also saw in the last several years a number of governments topple, especially those in the Middle East. And so if you look back at history, after financial crisis, it takes a very long time for things to heal. It's not your garden variety recession. So for 10 years, unemployment outside of the U.S. has remained very high. You look at European economies and the Japanese economy, they continue their growth is in the basement. Wage growth has been non-existent. The middle class feels like it's hollowed out. And so when you feel worse off than you did 10 years ago, and by looking at the average worker's paycheck, that's exactly how they feel, no wonder we're in a period of gloom. So
what do you think is the biggest risk right now, and what would an investor do to protect themselves against that?
Yeah, I mean, I think what keeps me up at night is central bankers. I mean, the central banks have been just such big players in global markets, not letting capitalism and the natural economic cycle really run its course. And I worry they've turned into mad scientists. I mean, I know 2008 required drastic action, and I think what they did was acceptable, but I think they've held on too long. David Einhorn, who's a fantastic investor, it calls it the jelly donut effect. If you have a child, every child loves one jelly donut, but do they want 5 or 6? And I think we're at the point now where central banks with these policies, they're almost holding the kids down and forcing dozens of jelly donuts down their throat. The stimulus, it's just not working to what they thought it would. It's not helping the overall economy. I mean, interest rates are at 5,000-year lows. Half of government debt around the world is trading at negative yields. It really just doesn't make a whole lot of sense to me. What it has done is prop up asset prices, but I do worry that if investors call the central bankers bluff or lose confidence in the system, or another recession comes along, there's very little that the banks can do right now. And markets, while they may stair-step up, they'll take an elevator down if that does happen. So now to protect against that, I think that was your second question.
Yeah.
I mean, you've got to know how much risk's in the portfolios. Figure out how it did in the last downturn, the last bear markets, and if you're not comfortable with that, then make adjustments.
And positioning portfolios, meaning combinations of asset classes that you would have. How are you positioning these days?
Yeah, and I always tell clients, and I know they're used to this, but I always root for bad news. Volatility is a good thing because it gives you opportunities to take advantage of it. And most recently on the growth side, the equity side, we've been shifting some money from the U.S. stock market to overseas markets. Not that we're abandoning the U.S. markets, it's just that international and some emerging markets are cheaper, and the U.S. has had just such a tremendous run over the last 7 years. The volatility in the bond markets late last year, early this year, gave us a great opportunity to take advantage of some corporate bond investments. And then lastly, we found an interesting opportunity in preferred stocks. Now, to beat you to the punch, I know you're going to say this, but this is an investment advice, and before you make any changes, please consult your advisor.
Yep, all sorts of advisors, financial advisor, tax advisor. What's a preferred stock?
A preferred stock, briefly, it sits in between the capital structure between a stock and a bond. A bond in bankruptcy, the owners of that bond have a lot more rights than the equity holders, who are usually wiped out. So a preferred stock has characteristics of both a bond and a stock. Generally in bankruptcy, it doesn't fare as well as a bond, but it does offer you a higher interest rate to compensate you for that risk.
Very good. Okay. Well, Jon, thanks for spending time with us. What's PSG's website?
www.psgplanning.com.
Fantastic.
Thanks for having me, Brian.
All right, appreciate it. You're watching Your Future, Your Finances. That does it for us today. I'm your host, Brian Kuhn. Appreciate you watching, and we'll see you next time.